If you think the next UK housing crash will look like 2008, you're already behind, because this recession won't hit everywhere at once. It will start quietly, in specific postcodes, in specific cities, where price growth was built on fragile foundations, and by the time the mainstream media starts screaming about the UK property market collapsing, the smart money will already have repositioned. Today, I'm going to show you the 10 UK cities most exposed as Britain enters recession, not based on fear, not based on headlines, but based on real economic pressure points, rental stress, mortgage exposure, employment fragility, and behavioural psychology. And one of them might surprise you. But before we get to the list, you need to understand something critical about this phase of the UK housing forecast, because this is not just about falling prices, it's about liquidity. Right now, the UK property market isn't crashing in a dramatic freefall, it's suffocating slowly. Transaction volumes are down, mortgage approvals remain below long-term averages, and although UK mortgage rates have stabilised compared to their peak, they are still multiples higher than the ultra-cheap money era that inflated prices between 2020 and 2022. That era created a dangerous illusion. Cheap debt disguised weak fundamentals in certain cities. Investors piled into areas with low entry prices and high projected yields. First-time buyers stretched affordability because monthly payments looked manageable at 2%. Developers overbuilt in specific apartment-heavy zones, assuming demand would never slow. Now refinancing is happening at 5% or more. And this is where the separation begins. In every downturn, there are two types of investors. The unaware investor waits for confirmation from headlines. They anchor to peak prices. They assume property always goes up. They focus only on average national data. The strategic investor studies local vulnerability. They analyse employment sectors. They track arrears and rental demand shifts. They understand that recessions don't hit prime areas the same way they hit speculative growth markets. So when people ask, is now a good time to buy property in the UK, the real answer is, it depends entirely on where. Let's start with the pattern I'm seeing. Cities most at risk share at least 3 of these traits: heavy reliance on public sector employment, rapid price growth during the low-rate boom, high levels of buy-to-let ownership, new-build apartment oversupply, and stretched affordability ratios. And when you overlay that with rising arrears and refinancing pressure, cracks start to form. The first city showing clear vulnerability signals is Nottingham. Over the last cycle, Nottingham saw strong investor demand driven by yield marketing, student population, regeneration promises, affordable entry prices. But wage growth hasn't kept pace with price appreciation. Investor concentration is high in certain postcodes, and new apartment supply has added rental competition just as tenants face cost of living pressure. In a tightening recession, that combination can compress rents while mortgage costs stay elevated. That squeezes leveraged landlords first. And when landlords start selling simultaneously, prices don't fall gently. Now here's where it gets interesting. Liverpool has also been marketed heavily over the past decade as a high-yield hotspot. Regeneration headlines, waterfront developments, investor-led demand. But parts of Liverpool remain structurally dependent on lower-wage sectors. If employment ticks up even slightly, rental arrears can rise disproportionately. And unlike owner-occupiers, leveraged buy-to-let investors respond faster to cash flow pain. That's when liquidity disappears. But it's not just northern cities. Birmingham sits in a more complex position. Long-term fundamentals tied to infrastructure and business relocation are strong, yet the city has experienced intense new-build apartment delivery. In a recessionary environment, oversupply in specific districts can push sellers into competition, and competition in a weak demand cycle equals price softness.
Remember, national averages hide local drops of 10–15%. The same structural tension exists in Manchester. Now, before you panic, Manchester has one of the strongest economic stories outside London, but that strength attracted enormous investor capital. When a market becomes investor-heavy, volatility increases, investors exit faster than families, and recession psychology amplifies that. Let's pause here, because this is where mainstream narratives mislead people. You'll hear, the UK housing crash hasn't happened, or prices are only down slightly year on year. But that's not the full picture. The adjustment phase in the UK real estate investing cycle often begins with stagnation. Sellers refuse to accept lower offers, buyers wait, volume drops. Then refinancing pain accelerates forced sales, and forced sales determine direction. Now consider Leeds.
Leeds has diversified industries and a strong student base, but like many regional hubs, price-to-income ratios expanded rapidly during cheap credit years. If wage growth slows while mortgage resets increase, affordability tightens dramatically for first-time buyers, removing the bottom rung of the ladder. Without entry-level buyers, the entire chain weakens. Sheffield faces similar exposure: historically affordable, significant rental investor presence, sensitivity to public spending cycles. In recessions, areas dependent on public sector stability can experience slower wage resilience than expected. Now let's shift south. Bristol experienced extraordinary price growth over the past decade. Desirable lifestyle city, tech presence, commuter appeal, but affordability stretched aggressively. When prices grow faster than earnings for years, even a small rise in UK mortgage rates can freeze demand. Frozen demand in high-valuation cities leads to sharper percentage corrections. And then there's Reading, heavily influenced by London commuter economics. When hybrid working reshapes commuting patterns and recession dampens corporate hiring, premium commuter pricing becomes harder to justify. Demand softens quietly but meaningfully. Leicester and Coventry round out the list of high-exposure cities due to rapid investor-driven expansion and affordability sensitivity. These markets performed strongly when credit was loose, but in tight monetary cycles, growth markets without deep wage expansion are the first to cool. Now here's the part nobody talks about. Collapse doesn't mean apocalypse. It means relative underperformance. In every downturn in the UK property market, capital rotates. Prime, supply-constrained areas hold firmer. Secondary, investor-heavy areas soften more. That's not fear, that's cycle mechanics. So what separates winners from losers in this recession? Winners are analysing micro-locations. They're stress-testing rental coverage at higher interest rates. They're negotiating aggressively in slower markets. They're prioritising properties with intrinsic scarcity, period homes, strong school catchments, transport links that already exist, not just proposed ones. Losers are buying based on old yield spreadsheets calculated at 3% interest. Here's the reality check. A true UK housing crash requires forced selling at scale, and while we are not there nationally, pockets of stress are emerging. Arrears are ticking up modestly. Landlords facing regulatory pressure are reconsidering portfolios. First-time buyers are more rate-sensitive than ever, and psychology turns slowly until it turns fast. So is now a good time to buy property in the UK? For the average buyer chasing appreciation blindly, no. For the strategic investor who understands local fragility and negotiates accordingly, potentially yes. Recessions create price discovery. They remove speculation. They expose weak fundamentals. But they also create entry windows that only appear once a decade. Here's what I would do in this phase of the UK housing forecast. First, assume mortgage rates stay higher for longer than social media predicts. Second, focus on rental resilience over projected growth.
Third, track days on market and price reductions in the cities we discussed. Liquidity tells you more than headlines. Fourth, hold cash reserves. In downturns, opportunity rewards patience. And finally, detach emotionally. Property is not immune to economic gravity, it never has been, but it also doesn't collapse uniformly. The investors who build real wealth during recessions are not the loudest. They're the great, disciplined strategists from over-leveraged speculators. Some of the cities we discussed will correct more than national averages. Others will stabilize faster than expected. But what matters most isn't predicting headlines, it's positioning intelligently. If you've watched this far, you're already ahead of most investors. You now understand that the question isn't whether the UK property market will change, it already is. The real question is whether you'll react emotionally or strategically. Because recessions don't destroy opportunity, they redistribute it. And the investors who prepare before the crowd always have the advantage. If this gave you clarity, stay close to the data, stay rational, and remember, in property, timing isn't about predicting panic, it's about recognizing pressure before it becomes obvious. And now you can.